Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. Khoon, Head of Asia Research, ANZ, Economist, and Forex Strategist joining in. Khoon, good morning and welcome to the show, and always a pleasure to speak to you. My first question coming to you is, with the quantum of liquidity that the global markets are infusing right now, are you expecting this kind of trend to continue? And if yes, what's the kind of impact are we expected to see on the Forex market?
Well, the ample liquidity that we currently have is most likely to continue to persist for some time. I think the major central banks around the world, most importantly, the US Federal Reserve, has committed to keeping policies very accommodative for as long as it takes for the economic recovery to take hold. So for the Fed, for example, which has been supplying the bulk of the liquidity, we're anticipating them to keep to their QE program for the rest of this year. They might start to taper maybe sometime next year, but even then, we're talking about tapering, which is a slow reduction in the balance sheet. They're still set to keep interest rates pretty much at zero until 2023. So that will still ensure ample liquidity for quite some time.
Right. So with that, overall, if you go to see with regards to what's happening to the dollar index, clearly, everyone's anticipating that it will cross levels of 93. But if that does, do you think that's something which is sustainable from here on and it will continue to inch higher?
Now, my view on the dollar is I still believe that the dollar is on a structural decline. Now, we've seen the dollar strengthen in the past couple of months or so, and now that's mainly because we've seen US 10-year yields rise on the back of much better expectations for US growth. That in turn has fed into expectations that inflation in the US is going to be higher, and markets are starting to get excited about potentially the Fed being forced to bring forward rate hikes. So that's seen 10-year yields spike higher. That's lent support to the US dollar. But I see those, particularly the move higher in the US dollar, as temporary. I think what we're seeing is positioning short dollar positions getting unwound, which has contributed to the dollar rally that we've seen. I think we're probably going to see the dollar now stabilize and consolidate. And I anticipate the next move for the dollar will actually be lower later in this year because, yes, the US economy is strong, but the global economy is also going to be equally as strong, particularly in Asia. And the US still has very large twin deficits. Now, part of their strong growth is because of the 1.9 trillion fiscal stimulus under the Biden administration. That's going to blow out their fiscal deficit, and eventually twin deficit of that magnitude that the US is running is ultimately going to be negative for the dollar.
Absolutely. So if that's going to be the scenario, now, similarly, if you come back to the euro as well as the yen, it seems these two currencies have been suffocating in this rising yield environment. Now, clearly, euro as well as the yen seem to have turned into the market's favorite funding instruments, for carry strategies, whereby investors are borrowing in a low yielding regime only to deploy those funds in higher yielding assets abroad. How do you see this entire scenario panning out?
Now, for the yen, I totally sympathize with its use as a funding currency because the Bank of Japan still remains committed to keeping, particularly the 10-year JGB yields within a very, very narrow range of between 0 to 0.35%. So that means that as the US 10-year yields rise, we see a widening yield differential in favor of the dollar, and it makes it very attractive for the yen to be used as a funding currency. So I think the yen will probably continue to stay somewhat weak. Now, when it comes to the euro, however, yes, Europe has negative interest rates, so definitely it's got large negative carry. But don't forget, from a fundamental perspective, Europe still runs a current account surplus, very different from the US, which is running deficits, and that deficit is set to worsen. Now, in Europe as well, what is also weighing on the euro at this particular point in time is the differential rates of vaccination. And also, we have seen cases where infections have been spiking in Europe, which has triggered fresh restrictions, for example, in Germany and France. So that's also led to the weakening in the euro currency that we've seen recently. But once again, I think these things to me are temporary. I think eventually Europe will start to bring their cases down. And while they're having problems with their vaccination rollout, I think once those issues are sorted out, you will start to see vaccination rates start to pick up in Euro and start to catch up to the US. So once that happens, I think that's when you'll start to see the Euro currency starting to come back into favor by investors. And that's why I still anticipate the Euro to appreciate past 120, heading towards 122 by the end of the year.
Right. And with this, if you have to talk about the pound as well, do you think there is an underappreciated risk that could come back to haunt the pound later on?
Look, sterling's actually done remarkably well in light of the rally in the dollar that we've seen. Once again, what has been helping the pound is their very, very good vaccination rollout. Amongst the major economies, they have the highest vaccination rates. So they look on track to be the first major economy to achieve herd immunity. And we are at this stage now where markets are definitely rewarding countries that are getting the pandemic situation and the vaccination rollout, doing well. So that's definitely benefited sterling. And with that, we're going to see a continued opening up of the UK economy, which means that the UK economic recovery will start to gather strength pretty much from the second quarter onwards. So I believe that's what's been helping to keep sterling up. And if they continue to do well on the vaccination front, there's no reason why sterling can't continue to appreciate towards and even surpass 140.
Right. And amongst the Asian currencies right now, where are you seeing higher traction? Where are you seeing higher strength that would continue, taking the way bond deals are panning out across, taking the way the equity markets have been performing?
Now, in Asia, I'm still very positive on particularly the export orientated currencies such as the Sing dollar, Korean won, even the Chinese yuan as well. There's no doubt that higher US 10-year yields in the past have caused financial market volatility and led to declines in the emerging market currencies. But I think this time, the root cause of what's driving US 10-year yields higher is expectations of a much better US growth outlook. Now, if the US economy is doing well, ultimately that's also going to be very positive for Asian growth as well. And we've seen upward revisions to Asian GDP growth forecast. We're anticipating China to grow at 8.8%. We're expecting strong growth from many of the other Asian economies here. So for that reason, I believe Asian currencies can stand up or withstand higher US yields much better than, say, what happened in 2013 or even 2016. So we're still very, very positive on Asian currencies at this stage.
Right. And specifically, what would your view be on the Chinese yuan? Because investors have turned bearish on all Asian currencies, and this is almost for the first time that we are seeing since last summer. Do you think this is something which would continue?
I anticipate that we will start to see Asian currencies and Chinese yuan in particular start to appreciate again, probably towards the middle of this year. I think once we get past this period where the dollar will continue to consolidate as the market gets more accustomed to higher US yields. But eventually, I think we'll start to see a situation where the Chinese yuan, for example, will start to strengthen again as it normally does over the second half of this year. Once we see further evidence that export growth coming up from China remains strong, the Chinese economic recovery remains on track, and importantly, ultimately, we are still going to see ongoing foreign inflows into the Chinese market, particularly the bond market, because there's been confirmation that Chinese government bonds will be included in the World Government Bond Index from late October. So that is going to pretty much guarantee a consistent inflow of foreign funds, which will be supportive for the yuan. So my forecast for the Chinese yuan is for it to appreciate towards 6.30 by the end of the year.
Right. And very lastly, Khoon, if you have to see the Indian rupee as well, overall, taking into consideration with what's happening on the US dollar, the anticipation is that probably there could be a limited downside with regards to US real rates from the current levels, and therefore limited room for dollar weakness overall. So, if we expect the dollar to strengthen gradually, do you think rupee could likely depreciate towards 76, 77, 78 levels to the dollar in FY22?
I don't anticipate such a degree of weakening for the Indian rupee at all. Even though the virus cases recently have spiked up and that's seen fresh restrictions in some places coming on. Overall, I'm still very positive on the economic rebound in India. I'm anticipating 10% GDP growth for FY22. In terms of the rupee actually would have been a lot stronger than it is right now if not for the RBI's persistent heavy FX intervention. It's very clear the RBI wants to ensure the rupee doesn't stay too strong. They want to keep the rupee competitive. That's why they've been intervening massively both on the spot and forwards market. Now, because of this intervention, that also means that the rupee definitely has potential to absorb or ride through stronger dollar or even higher US 10-year yields, because all the RBI needs to do is ease back on their intervention, and the rupee can still continue to stay stable. I think one of the positive aspects about the Indian economy is that despite the deep recession globally in 2020, we still saw a lot of inflows into the Indian market, not only in the equity market, but more importantly, FDI flows have actually picked up. And I think what we are starting to see is a lot of multinationals taking advantage of what's been happening and looking to make long-term investments into India, because there's a recognition that for a lot of large companies, they are still underweight in India, but India still offers very good medium to long-term growth opportunities. And therefore, a lot of multinationals really want to start to get set and get more exposure to the Indian economy. That's why the flows have been very strong. And that's the reason why the RBI has been trying to absorb those flows and trying to prevent the rupee from strengthening. So I'm not bearish on the rupee at all. I think it can continue to maintain stability even in light of higher US yields.
Right. So what could be levels, according to you, that we should be watching out for on the Indian rupee?
Look, I think the rupee looks to be fairly comfortable within the 72 to 75 range. So I think there's no reason why we can't continue to maintain that range. After all, the RBI now has the fourth largest FX reserves in the world. So that's plenty of firepower that they can deploy to ensure that the rupee can remain stable and won't weaken too much.
Right. And Khoon, very lastly, as we mentioned, the RBI right now, we have an upcoming policy meet as well. Do you think that the RBI will stay vigilant but hold the fire by keeping their accommodative stance, by keeping a status quo with regards to interest rates as well? And if that happens, do we see any major impact on the currency? Or do you think even if they go ahead increasing interest rates from here on, taking the US bond market into consideration, will we see some major movement coming in, which could be a knee-jerk reaction?
I don't see any need for the RBI to move policy rates at the upcoming meeting or for the foreseeable future. With the rebound in the Indian economy, there is really no need for the RBI to cut rates anymore. But by the same token, there's no urgency for them to hike rates either, because inflation is still within the RBI's target band. Even though where oil prices have risen, we will start to see some pressure on inflation emerging, particularly in oil-sensitive prices. But we don't anticipate inflation to get out of hand or to persistently breach the top of the RBI's target band. So the RBI actually, I believe, has the ability to be patient and keep policy accommodative, probably for the rest of this year, to ensure that the economic recovery really takes hold. And I think come next year, that's probably the time when they will be able to assess the need for whether or not rates will need to start to normalize or not.
Right. So that's with regards to where the currency markets go. Thank you, Khoon, so much for joining us on the show. Always a pleasure to have you. Stay safe and speak to you soon again.
Likewise. Thanks for having me. Bye.